Thank you for joining us. Today, we're excited to bring you a brand new show from the Onramp Media umbrella. Wake Up Call is a weekly show that will be streamed live on LinkedIn every Monday morning. To catch the premiere of each episode, follow Onramp's LinkedIn page and add Wake Up Call events to your calendar. After the live premiere on LinkedIn, we will distribute each episode across Onramp Media's podcast channels and YouTube page. Wake Up Call aims to educate financial professionals on the merits of the Bitcoin investment thesis, how this asset represents both a threat to legacy financial service businesses and an opportunity to differentiate oneself and retain and attract new clients. Hosted by Mark Connors, Onramp's head of global macro strategy, and Rich Kerr, Onramp's president of managed wealth, this show seeks to provide financial professionals the wake-up call they need, prompt them to have an open mind with respect to Bitcoin, rethink their prior assumptions, become more educated on the topic, and learn from others who are already farther down this path. Mark and Rich bring a combined 60-plus years of experience across traditional markets and financial services, and will share their unique perspectives in how their peers and colleagues can approach the realm of Bitcoin. Wake Up Call will feature guests from various backgrounds and industries who will also share their own journeys to Bitcoin and how others can get up to speed. Now, time for the show.
Well, good morning, everyone, and good morning, Mr. Connors. Good to see you.
Good morning, Mr. Kerr.
Yeah, good morning. Kevin Jiang, CIO and Portfolio Manager of Virgo Digital Assets. Welcome to the show. We appreciate you joining us this early Monday morning for you.
Thank you, Rich. It's an honor to be here.
We're delighted to have you. And, it's interesting. We were talking in prep, Kevin, I think you're out on the west coast of Canada, if I'm not mistaken, Vancouver area. Is that correct?
Yep, that's correct.
And you had a couple of black bears this morning rummaging through the neighborhood and giving you quite a show. So we're off to a banner start on a Monday then.
That's right. Yeah, there's quite a bit of wildlife around here, around my neighborhood. It's good. Yeah, we keep our garbage pretty safe.
Well, good. We're delighted to have you today, and also with all of your incredible experience in the digital asset space, and helping kind of pave the way or pioneer ETFs in Canada. What was that? I believe 2020, March of 2020, when Canada rolled out their initial ETFs, and so we're delighted to kind of pick your brain on the things that you've seen in Canada and Australia, and then at the same point in time, just some of your observations on how things are going here in the United States. So, but before we get into all of the fun and interesting things that you have to share with us, I figure maybe we'll kick off as we often do with Mark and some of his insights. And Mark, I obviously I always scan the news and try to find newsworthy events, and obviously what's happening in the United Arab Emirates. They had a nice and interesting announcement for cryptocurrency holders in the UAE. And I think what was it last week we had Ralph Gibran who lives in the UAE, and so the announcement there, not having taxes on cryptocurrencies, I think was quite an interesting one. But it always seems to come back to global debt, global money supply, GDP, deficits. And so I'm curious, what's on your mind today?
Yeah, I mean, governments are playing with a whack-a-mole of deficit stomping, trying to keep down the expenses as tax revenues are 4.4 trillion, and you have deficits, approaching 7. Expenses over, 7 and growing. So that the headlines this week, Rich, were all about unemployment on Friday, and not for no reason. We had a very surprise 50 basis point cut. Everyone was very happy. Everything rallied. And then we had an unemployment number that declined from 4.2 expected to 4.1. And we had a jobs, non-farm payrolls that went up by over 100,000 jobs. I think it was 155 up to 245. But that's relatively noise. It's relative noise because if you look at the trajectory of unemployment. It's got a sort of a band of error that's about that amount. So pushing that down, the real signal was from the fiscal year for the U.S. closing September 30th. So on Tuesday, October 1st, which was the day before we had our macro spaces, which really fed a lot of what Jesse Myers, we had Larry Lepard on, we had Peruvian Bull. And the reason I'm highlighting is because we started talking about about the unemployment number and about debt. And then as it happened, someone brought up these numbers that just posted on the Treasury website. Debt was up 6.7%. So just put that in your head, year over year. GDP now, which is coming out this week from the Fed, Atlanta Fed, is expected to be 2.5. You cannot make up for that spread in volume. You can't. You're spending to buy growth. It sounds too simple, and we're going to come down with some concrete numbers to show what advisors can do to kind of stay ahead of purchasing power for their clients. But that is the riddle me this, Batman comment of the year everyone has to have. If debt continues to grow at 6.7%, it's actually grown at 9.5% over the past 4 years. And it grew $204 billion on the next day in the new fiscal year. That's a rate of over 50% annualized. Crazy number, but just to show you, when debt increases, all of a sudden, maybe 3 or 4% on your T-bill, or 4 or 5, isn't a good number. So that's what we're here. I'll kick it off with, don't focus on the data of unemployment and what individual companies are doing in their hiring. They're going to ebb and flow with people. The real issue is that the government doesn't have innovative abilities like an Amazon, like a Meta, like an Onramp, or a Virgo, who are trying to go after new opportunities. They don't have that cycle rate. So the only lever they have to pull is issuing debt. And so with that, Rich, that nice little nugget, let's go give some things that people can be happy about, or opportunities, because we think that's going to grow. And given that, on the market side, are advisors aware of this, Rich? I'll throw it back to you and Kevin. Do they kind of not need to know about it because equities are up 20% in the year and they're fine kind of playing that game?
Right. Like when we see like debts being issued by sovereign countries, that's really a dilution in purchasing power over the long term, right? Like I heard a story about like two soldiers going off to a Vietnam War, or like one buries $1,000 in his backyard in cash, and the other buys $1,000 worth of stock, right? Completely different outcome for the two. So that's a reduction in purchasing power in cash versus the compounded return of something that just grows, which is the U.S. capital market. But for investment professionals, like we're not really evaluated on the reduction of purchasing power, right? Nobody is. We're evaluated on the rate of return on the investment and the risk that we're taking to achieve that result. So, but for clients, that purchasing power really matters. I guess there's a huge opportunity there, right? Like for advisors and for asset managers to kind of differentiate themselves by mentioning purchasing power and how we manage that through investments for their clients.
I've never heard it stated that way, and it's really powerful, Kevin. The fact that financial advisors, financial professionals are not measured on the purchasing power of the individual, but the return characteristics that are provided by the advisor, and it's never lost on me, and I've said this countless times on this show, that every time I speak with an advisor or I go into an advisor's office, I'm always asking them, what are clients concerned about? And inevitably, over the course of the past, 6 months, it's been inflation. right? And I think about it, inflation obviously, is and loss of purchasing power are tethered together quite well. But I think it's the idea that we're not providing solutions to the pain that an individual client is experiencing, not fully. And I think you have to go out and really take a look at how individual investors are having to modify their investment plans in order to keep up with this loss of purchasing power, which has continued to erode. And I say, largely it's not the 15-year track record of Bitcoin that you need to be paying attention to. It's the 111-year track record of the U.S. central bank debasing the currency and the loss of purchasing power of the individual that is causing the challenges that we face today. And it inevitably, I think people will wake up to that and be able to uh, demand some level of solution, whether that comes from their financial professional or, the government and that is issuing the currency or whatever it might be. I think ultimately people are going to feel a lot of pain here and are experiencing a lot of pain, and taking undue risk with their capital in order to be able to try to keep up with the loss or the degradation of their purchasing power. I don't know, but I love the way that you just stated the incentive there. So thank you.
Yeah, hey, Rich, following on that, and Kevin, the part I love working with you is that you were always thoughtful and approached it from a first principle standpoint that I thought was unimpeachable. And pressing your point about advisors aren't necessarily graded by that, but investors invariably, and this is an assumption, invariably are more sensitive to what their money's able to purchase. When will that flow back to the advisor and change behavior to know that the hurdle rate is no longer, 3 or 4% risk free? It's really 8 or 10 because their insurance for their house, their education for their kid, everything is growing at 8 to 10% a year. We have the data. So when do you see that at all? Like you're talking to investors now as a CIO of Virgo. Is that something that still kind of isn't top of mind for folks, or is it changing?
Um, I think a lot of people are becoming more aware of the overall global macro environment now. Like in the past 30, 40 years, we were in a period of globalization, right? Which means things were being offshored. Um, the daily household items were cheap, or or we're not seeing a huge reduction in purchasing power in that particular sector, which make up like most of our day-to-day purchases, right? Like if you a number of transaction wise, that could be like 90% of our daily transactions. We only pay tuitions once a year. We only buy a house, once a couple of decades. So like so what we notice on a day-to-day on a day-to-day level is low inflation over decades, which is what kind of took us to a long period of zero interest rates, and inflation were not higher, right? Even though we were increasing our deficit year over year, our national debt is increasing in both U.S. and Canada, and there's a lot of government spending, right? That was the reason. Globalization was the reason, and now that music, right, is changing its tune a little bit in the coming years, right? Everybody knows that. So what we experienced in the past, the inflation we experienced in the past few years, right, was caused part by monetary policy and part by supply chain constraints. And that's just a taste of what's to come, right? Should this world get any crazier than it already is.
Yeah.
So at that point, people will become more aware of the reduction in purchasing power. So like, for example, in Canada, like real wage growth in the past 10 or 15 years has been pretty much zero. real wage growth, right? I could hire an intern right now for the same salary that I earned when I was an intern 20 years ago. So when prices go up, people really do notice because their paycheck is not getting any bigger.
Yeah.
Prices are getting higher, and things are getting more expensive, right? So yeah, definitely people will notice.
Well,
And that's
Kevin, I could tell you, one thing that I always like to do is just maybe take a step back and share with our audience a little bit about your background. Mark and I have a little terminology that we often say. We always love having bilingual guests, and what we mean by that are guests that came from the TradFi world, and are fluent in that system, but at the same point in time are really well acquainted with the digital asset space. And I'm fascinated. I mean, you've been in the industry for roughly 15 years. I believe 10 of that in traditional finance, and then you made the move into the digital asset space. 4 or 5 years ago, and so I'm fascinated by what was your triggering event and what pulled you over into the digital asset space at that stage in your career.
Right. Thank you. That's a great question. That's a question I keep asking myself as well. Like, because uh, because like I've been a trader for a very long time in the traditional world, and there's the saying like if you're not bullish, you should like if you should get out of your position, right? If you're not bullish on on whatever you're holding, right? And that goes the same goes for your career, for your job, as well as for your portfolio. So that's a question that I constantly ask myself. But in the digital asset space, what I see is an opportunity for explosive growth. And I've kind of seen that in the previous cycle. We kind of saw that last year or this year when the ETFs are introduced in the U.S. And I know we're going to see that when the options on the US ETFs eventually come out. They were recently approved about 2 weeks ago. God knows when they will actually list and start trading, but that's going to be another area of explosive growth, right? Some people expect to see like a GameStop type of scenario. Once we have hedge funds start shorting those options for yield, and then retail just come in, right? Gamma squeeze the heck out of them. I don't know if that will happen, but one thing I know is that the market will just get bigger. It will get more liquid. We have institutions and professionals will have more tools to hedge. There will be ways to generate yield. There's many ways to cook with this ingredient of this amazing ingredient of Bitcoin. So yes. So digital assets is an area for explosive growth, and that's why I came into this space, and that's why I'm still here.
At Onramp, we believe that Bitcoin is the most important asset of the 21st century. The hard part is securing it right. There are shortcomings with keeping your coins on an exchange, but also with setting up your own self-custody arrangement. Onramp solves for these concerns. Our multi-institution custody solution maximizes security and minimizes counterparty risk, ensuring that your Bitcoin remains securely in your possession, and provides built-in inheritance planning to ensure your family is protected as well. Onramp provides peace of mind for your Bitcoin journey, whether for your whole stack or for part of it as a complement to your existing self-custody setup. For more information, check us out at onrampbitcoin.com.
Yeah, it's. I wish I had the foresight that maybe you did. I spent 33 years in the traditional finance side of the equation, and similar to I think a lot of people when I first heard about Bitcoin, I kind of poo-pooed it and dismissed it. It just seemed like I don't know, a fad, not worthy of my time and attention, not serious money. And I just kind of dismissed it, and I dismissed along with it, my intellectual curiosity. And I only later circled back and really kind of started doing the work, and then I, was like, well, geez, I love it. I'm fascinated by it. I'd love to see it kind of integrate into our company and find a way to be a first mover, or close to at least a first mover in the United States, and bring forward Bitcoin solutions. But I don't think our company was broadly at that place, and I didn't have the wherewithal at the point in time to just be able to say, "Am I bullish?" like you just described, right? And so I kind of stayed in and just focused on providing client care and in the best way that I could, and bringing, um, I guess, credible solutions forward in the traditional sense. But there became that point for me as well where I just said, okay, I'm so bullish on Bitcoin, and I really do feel that I have a responsibility to kind of step forward with my point of view, and that's what ultimately led me here to Onramp. But yeah, I love the simplicity of just being able to say, if I'm bullish on something, then go all in, on what it is that I'm wanting to do. So whether that be portfolio or career, I guess it all kind of aligns. So thank you for sharing that.
Yeah, both of you came in for, I won't say different reasons, but I loved how Kevin took his practitioner's discipline of examining the portfolio, minute by minute, and saying yes, 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 no, no, no. Do I want to remain long? And then pulling it back and saying, well, how about the guy making the decision? Am I long, long? Yes, 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 on trading fixed income arbitrage or the like, uh, and trying to meet certain benchmarks. And you said no and moved it. And then Rich, not putting words in your mouth, but after 30 odd years at Schwab, you decided to come in and be able to speak to something to advisors that you thought was pretty big as well. Do you think this is I was going to potentially, we're talking global debt, we're talking about the advisor market, kind of big topics. What do you think about bringing up a little bit of data to try to feed the data junkies out there that like numbers?
Yeah, yeah. Well, you got terminal handy? You got something interesting you want to share?
I got the terminal. So what Rich just referenced, and Kevin, not sure if we told you, I think we shared this a little bit about what we have here at OnRamp, is we call it the Bitcoin, it's the Bloomberg of Bitcoin. So what we try to mix here is have a research and markets-based single point of access for anyone interested in Bitcoin. So when you talk about Bitcoin, everyone loves price, so we start with that. I don't know if it was Kevin's point about the portfolio, but someone moved the market up here on the day. We talked about equities being up 20%. I think people forget that Bitcoin is up, on the order of 48% on the year to date. Where is that number?
52.
52% on the
Yeah.
year.
Yeah. Like it's the best performing asset class this year. Again, rating champion.
Reign champion, and it beats everybody over a 10, well, since inception, 10-year, 5-year, 3-year. It even beats a software and services sub-index of equities. But if
Yeah.
anyone wants to dive in, we can give a call. Just hit this up and you can contact one of our specialists. I like to look at the 200-week moving average, kind of, taking that daily chart and getting a little perspective. So we're going to look at Bitcoin. We're going to look at Bitcoin in context. We're going to look at Bitcoin relative to the market, and then bring it back to what Kevin said about the options, as far as it relates to the broader market. So this shows you the 200-week moving average, which has been a point of resistance. I won't go into why now, but it has been a good resistance line. And the color coding just tells you the distance from it. Is this a good entry point? A little toppy here, as we found out in 2021. This was obviously the dip here in the winter of December 22. and we're kind of in the middle ground here. So, that's, I won't talk about price recommendations, but make your own opinion. The other metric that I've highlighted, you can take, these are my favorites, is dominance. So there are tens of thousands of tokens. There's dog with hat, and, Elon's Doge and all that. But when you look at Bitcoin currently, and this is the blue line, this is the dominance. It is currently 56, almost 57% of the entire $2.2, $2.3 trillion market. It is also the 10th largest asset in the world, larger than Berkshire Hathaway, which I love, because the irony there is not lost on hopefully anyone here, where you have Warren Buffett and the recently departed Charlie Munger call it rat poison. Maybe they're a little jealous because it's got a larger market cap in 15 years than what Berkshire did over a 70-year, 55-year, 70-year career. So it is the digital asset market. And then the last metric that I like to look at is bringing it front and center to what advisors try to do, is just look at what's happened. Kevin talked about the catalyst of options. 50 billion right here, 50 billion, 49.2 of ETFs. And as Eric Balkunas at Bloomberg said, highlighted, I think BlackRock got it there in 49 days. And I think Fidelity got to 10 billion. Rolling back to IBIT and BlackRock's ETF and Fidelity's ETF were the two fastest ETFs to $1 billion. BlackRock took 49 days. Fidelity took 72 or 77 days. The previous record was a JP Morgan equity ETF, and it took over, I think, 2.5 years. So they smashed the record. Even if you do inflation adjusted, it was a pretty big number. So Kevin, to your point about why we having you on here, you've been here for 4 years. You've seen the ETFs in Canada. You watched it happen. You weren't surprised what happened in the US. And now you are highlighting, unprompted by us, are highlighting the fact that the options market's going to invite more of the market in. And you think that's a net demand, not a net long short. You think that's net plus.
Yeah. So for options, like the most, like the most use of it is for hedge funds or institutions to generate yield, right? Bitcoin's option market will have about a 60 to 65% implied volatility, which means that, like, if you know how to delta hedge properly, you could sell a out of money straddle, like 25 delta straddle, for perhaps 20 to 25% annualized yield, which is very lucrative, especially now that our risk-free rate is going down, right? Like it's at 4% right now, 1-year treasury. That number could be 3 or 2.5 in a year from now, right? So yeah, 20 to 25% delta neutral, right? If the hedge fund knows how to hedge, which they sure will, they know better, they know how to do that better than anybody else in the world. And Bitcoin is a continuous trading asset, so there's no gap risk, right? Like for example, GameStop, right? Like one thing that really hurt them was that it will always gap up at the open, and they will have no way to kind of cover their short. But Bitcoin is a continuous trading, so if they have exposure, they can hedge on Coinbase, or they could find their way offshore, hedge with a perpetual contract, and rather than wait till the market to open. So yeah, I think a lot of institutions are probably licking their chops right now, and they're gonna get in this market. And so if they do that, and there's a directional market movement, they are gonna delta hedge, right? Which means that that's just gonna be rocket fuel to whichever direction that Bitcoin is going. Probably more so on the upward direction than on the downside. So yeah, that's gonna bring a lot more new capital into the space?
That's crazy.
Rich, so when Kevin and I, coming from the markets side and me from risk, Kevin from trading, the derivatives market, it's like it is, people can't get enough of it. It's cheap, liquid, often listed options are wonderful. It's a leveraged way to get exposure. It's quick on, quick off in many times. Spot can be a little more problematic. So what I want to relay just from my side, and I don't know if Rich, the question's to you of, if you look at the derivatives market, the reason we had the '08 crisis, one of the big ones, is because of the size of the derivatives books on the banks. People didn't trade spot. They said, oh, let's just trade a derivatives contract. And they didn't even close them out. They just said, I have one long, I'll buy a short, I'll net it off. I don't have to cross a bid ask. It's a technical issue, but the size of the derivatives market for, like, say, a bond issue could be 100 times larger. One could be $1 billion issue and have 100 billion of derivatives against it. 10 to 50 times is kind of normal in the fixed income area. Equities might be a little less because of the higher vol. But the point, the reason I mention this is because the number of players that are going to be attracted to this, I think, and I don't want to overstate anything, is going to be larger than just the spot ETF. It's going to be a larger levered players are going to come into what Kevin said. So I guess, Rich, is that, I know advisors are into alternatives as a way to differentiate their books, but do they have an appreciation for, like, what's an example of them saying, I saw the opportunity to get into call overrights or some sort of alternative product that was able to give them value. Do they appreciate the fact that derivatives will give demand, or is that something that they just gonna have to see it happen in price because they don't appreciate the derivatives market?
I think a very large segment of U.S. registered investment advisors, independent registered investment advisors, generally do not stray into the derivative space on their own, right? Because they're small business owners. And that competency may or may not live inside of their firm. And more likely than not, it doesn't live inside of their firm. So they usually will, if they find something interesting, right, in the derivative space, they may look to partner with an asset management firm that has created a solution that embeds, whatever type of hedging and or yield generating strategy that they are intrigued by. And so I think that they will outsource that component of the portfolio through an asset management product. By and large, there are firms that have that competency. I don't want to dismiss that, and there may be some of them that are listening here today that would have disagreed with that. But I would say that's the rarer element, right? Because now you have to have a trading desk, and you have to have somebody that is intimately familiar with the options markets and know how to put those derivatives in place. And they also have to have a client base that they feel it's appropriate for. And that's the key thing, right? Because we're registered investment advisors. Everything is run off fiduciary standard and appropriateness versus suitability. And so they're constantly evaluating, does that have a place inside of the portfolio? And I think that if they do believe that they need to integrate it, they'll usually look to a partner who has a competency or an expertise above and beyond what they have in-house to be able to implement a strategy like that, Mark.
Got it.
Yeah.
Thanks for that.
Yeah, I mean, if you look at the broader dynamic, right, it's usually asset allocation, modern portfolio theory, and based off of a strong financial plan, right? It's the financial plan that leads, it's the portfolio that follows based off of risk tolerances. And that's the general way that most RIAs will approach things. So they'll have a core allocation, and then they might have an explorer satellite around it, and that might be where something, a productized solution might fit in for those types of firms that are looking to add some alpha to a portfolio.
Got it. So where we look at Bitcoin, especially for an RIA, as a gateway drug to and we think final, to the digital asset community, is that we think that the alpha is in the beta because of its unique return asymmetry, more upside than downside, its returns. But Kevin, obviously you at Virgo are harvesting a lot of that actively. So you're like, you are one of those specialists who's deep into the vol structure and the vol surface. Not to put words in your mouth, but maybe explain a little bit about just information about your firm that can help advisors understand what the options approval might mean for demand and why people are interested in it.
Sure. Yeah. So options is quite a powerful instrument, especially for an asset, explosive asset like Bitcoin, right? There was a story that came out of Canada like over the weekend. There's one guy, a carpenter. He grew an $80,000 portfolio into $400 million, trading nothing but Tesla options. Right? That's how powerful you could get. Like it's a 10x stock, but yeah, that's how powerful options can get. Like if you know how to time the market, if you're on the right direction at the right time, then
yeah,
it's the most powerful thing that most individual investors or institutions can get their hands on. So we actually have, like, we use options in a variety of ways, right? Like, for example, one of our products is principal protected. We actually buy U.S. treasuries, and we take the interest from those treasuries and allocate it into our actively managed option strategy. So that allows our investors to participate in Bitcoin's growth while having their principal investment protected by the U.S. Treasury. And that strategy has returned 22% year to date after fees. There's another option-based strategy that we do, which provides our investors with a levered Bitcoin upside potential and an unlevered risk profile. So when the market is kind of chopping, it kind of tracks the Bitcoin, as it's chopping back and forth. But when it goes up, our strategy goes up exponentially. So there's like options are like a magic ingredient, and that you could kind of dabble a little bit into a variety of strategies, and that will give you a totally different risk return profile for your clients. So it's quite an amazing thing. And Canada actually has spot Bitcoin options on our stock exchange. They were listed when we had our spot Bitcoin ETFs back in 2021. So they've been there for 3 years and 3.5 years, and the liquidity on them are pretty good, pretty decent. So but still, like we just can't imagine the size of the market when the options start trading on the U.S. Bitcoin ETFs.
I haven't caught the news, but are they going to release options on all of the ETFs, or is it just a few of them? I hadn't heard what the final statement was. Any insights there?
Yeah, so they officially approved the options on IBIT.
Yeah.
I guess each firm submitted different applications.
Okay.
And IBIT had the most ready application, and they were approved first. But then we all knew that SEC they don't want to play kingmakers in this game. If one ETF had options on them and the other didn't, that would be a huge advantage for that one particular issuer.
Yeah.
So they're probably just doing what they did when they approved the ETFs, which is wait for everybody to get ready and then give everybody the green light at the same time.
Okay. Yeah. Yeah. It's going to be fascinating to watch the dynamics that come from that. I guess you could parse it a million different directions. How they're being utilized to enhance or augment portfolios versus what it does potentially with the liquidity, to price. So it's going to be fascinating. So, yeah. Well, speaking of ETFs and the whole nine yards. So we're 9 months in. So generally speaking, what's your observations relative to, what you experienced with Canada 4 years ago, with the United States? Obviously, Mark shared, we've, seen some tremendous flows that are record breaking for some of these ETF products. And I'd be curious about your point of view, kind of historically looking at Canada when you rolled out the ETFs, in 2020 versus, here we are, 2024, 9 months in. What are your thoughts as a professional in the industry and expert in ETFs?
Right. So thank you for asking that. I used to be the portfolio manager on one of Canada's largest Bitcoin spot ETFs. During my time, one thing I noticed was that institutions use ETFs for liquidity. Because if you look at BlackRock's prospectus, right, like what index is IBIT tracking, right? It's tracking, they call it the Bitcoin benchmark rate, New York variant, which is, they call it the New York variant. Sounds like a virus, but it's,
I was going to say, who chose that? Who chose that language?
It's doing a TWAP, a time-weighted average pricing, trading between 3 to 4 p.m. New York time, rather than the London variant, which is London 3 to 4 p.m. London time. So it's just a TWAP, right? So if you're a large institution or pension fund, you're looking to buy $100 million worth of, Bitcoin to allocate, you're not going to get a trader or set up an algo just to kind of punch in orders repeatedly. The easier way is to just go to that ETF issuers, call them and say, hey, I want $100 million worth of your fund. Please sell them to me at net asset value. And being ETFs, they're kind of obligated to do that, provided that you submitted your order in time, right? So that tremendously reduces slippage for large volumes of transactions going in and out. And it's very noticeable, right? We've had ETFs that had $1 billion inflow days multiple times, right? And if you look at the hourly candle between 3 to 4 p.m. New York time, you're not seeing like a huge candle either way, right? It's mitigated. Like the market is absorbing that liquidity. $1 billion, boom, nothing, right? Not even a splash. So that's one thing I've noticed. Like they've really
Kevin,
mastered.
Is that absorption because they're not going to the ETF market, which is say 50 billion now? What those redeem and create people are doing is they're going to the spot Bitcoin 24/7 365 market. And are they creating or are they actually creating ETFs and buying later? How does that? I'm just trying to think of why there aren't candles if there's $1 billion coming in.
Right. So they buy from liquidity providers or market makers. So those are the likes of Coinbase, for example, right? And they provide that service, and they disclose that they provide that service for most of the ETF issuers, and they probably also have other sources of liquidity providers. And if they're smart, which they're brilliant, they're going to shuffle their allocate their trades across a variety of liquidity providers so that they can get best execution.
Got it.
But ultimately, those liquidity providers, they have to buy their Bitcoin from somewhere, right? And they have greater outreach than BlackRock or Fidelity, because obviously BlackRock will have a hard time from a compliance perspective to find themselves on the Binance spot Bitcoin market. So they are absorbing. The ETFs are absorbing liquidity or using liquidity from a global market rather than the U.S. market, and that is why, like, even on $1 billion days, you're not seeing like a big green candles or red candles between 3 to 4 p.m.
You just made me a little bit smarter, Kevin. So thank you for breaking that down for us. And I'm sure our guests are going, oh, that's interesting. So yeah, thank you for sharing that. So Kevin, I know we're kind of coming to the close here on our time on the show, but I'd be curious, could you share with the audience a little bit about Virgo? I know that you've sprinkled it in throughout, how you help investors, but how would an advisor find your firm?
Sure. Thank you. So our website is at virgo.co/VDAM. That stands for Virgo Digital Asset Management. We're a regulated licensed asset manager based out of Canada. And we're trying to get our U.S. licenses. Hopefully, in the near future, we'll be regulated in the U.S. as well. And we provide alpha-seeking products, actively managed, to provide our investors with a superior risk-adjusted return compared to Bitcoin. And we use like Bitcoin as a benchmark for quite a few of our strategies. Our flagship strategy returned over 200% in the past 2.5 years, right? And that's beating Bitcoin by about 150%. And of course, it's accredited investors only, and right now it's just Canadian accredited investors. So thank you for asking that. So once again, it's virgo.co/VDAM.
Excellent. All right. Well, Mark, if you don't have any further questions, we'll let Kevin get back to his exciting work. And Kevin, just want to say thank you for joining us. I know it's early out there in Vancouver area, and we appreciate you joining us early in the day, and wish you all the very best. And thank you for sharing some of your insights and experiences, frankly, in the space. I think, it's always good to have different perspectives join us and talk with our audience. And so we appreciate you. Thank you.
Thank you, Rich. Thank you, Mark. It's a lot of fun hanging out with you guys. So really appreciate it.
Good. Excellent. Well, thank you so much.
Thanks for listening to this week's episode of the show. If you found the information valuable, please share the episode with a friend or leave a rating on your favorite podcast app. All the links we discussed in today's show will be in the show notes inside your podcast app. Before we finish, a quick reminder that Onramp Media is for informational and entertainment purposes only, and nothing should be construed as investment or legal advice. Regardless of where you are on your Bitcoin journey, we'd love to hear from you. Visit onrampbitcoin.com/contact to schedule a consultation with one of our private client advisors.